What's going on, YouTube? Welcome back to Stocks by the Numbers. Wanted to do a quick update video here. Well, not really an update, but I had Nike randomly pop into my head, and then I began looking at a few other companies there in the sector, and I came across Deckers Outdoor Corporation. This is the company that I wanted to look at here with you guys. Ticker symbol DECK, listed here on the New York Stock Exchange. Now, this company, as we see, much more expensive per share than a lot of the other smaller cap stocks we've been looking at recently, but worth your attention. Right now, stock's trading at $476.77 a share. We're down 13 points, about 2.2%. Stock yesterday hit a high of $492.44. Shout out to Frank, because I posted a video last night and Frank let me know that the audio was messed up. He heard other people talking, so I had to take down the video, and I'm actually re-recording it and uploading it right now. And it breaks my heart because, again, unfortunately, I have a lot going on over here. My apologies. I'm really going to try to start pumping out more videos, but this is a 3-month chart, and as we see here, going back to the highs in the first week of April and the lows the second week, the highs in the first week of March and the lows in the mid of March, we can see that the stock basically formed like just this tight rising wedge over the last month or so, and has since, well, today broke out of this rising wedge, and of course is now pulled back below this simple moving average. So the stock now technically is in bearish momentum and will begin to pull back. Now, this company, by the way, Deckers Outdoor, this is a company, as we see here, apparel, footwear. They do UGG brand and some other shoes and apparel and whatnot. I'm not really big on fashion and shoes and whatnot, but hey, the company consistently beats earnings estimates and has been rising. If we pull up a chart here, basically just been consistently increasing in value over the last 30 years. So regardless of whether we like or support a company or not, sometimes we just have to follow the money. We have a market cap here of about 12.5 billion, and the PE sitting here at 26.5, so probably a little bit high, and I'm sure history will show us. However, the company, again, 4 quarters in a row beating on the EPS side, and even though the revenue does seem sporadic, going from $1 billion plus down to $600 million, the company actually consistently comes in above analyst estimates. So these dips aren't anything to be concerned about, because over the years, as we see, 1.9 billion up to 2, 2.1, 2.5, 3.1, now estimating about 3.55 billion for the end of 2022. And chances are they're probably going to hit that mark. And of course, looking at the profit margin, just maintaining, look at this, little above 13%, just about 13%, up to 15, down to 14.3. So the company not only is increasing its revenue, but of course they're earning more profit off of said revenue. And this is what you're supposed to see technically when you're looking at a business and looking at how the revenue is coming in, and more importantly, how much they're profiting off of said revenue. The more the company brings in, the more the company should make. So that's why when I used to look at other companies, I know like I'll occasionally bring up DraftKings, and that's because the company was losing more than it was making. And it's situations like that that kind of blow my mind, where a company will do like $1 billion, but lose 1.5 billion, and then they'll post like 2.2 billion, but they'll still lose 1.5 billion, right? And it's like technically that really shouldn't happen. If you were losing billion and a half off a billion, if we now bring in 2 billion, 2.2 billion, we should only be losing a couple $100 million. What happened to that billion plus revenue? Where did it go? Did we reposition it too early, where we should have, made ourselves look more healthy on paper to bring in newer investors and keep our stock even more and more attractive? Well, obviously, each company is different, and you never know where they may position their revenue when it comes in. Could go into R&D, could go into marketing and advertising. However, as we see here, Deckers, it's just going into their pockets. And the company goes from, 5 or 6% profit margin. Now they're maintaining these mid-teens here healthily over the years. So can't knock the stock for rising over the years. However, a little too high here. Even if they bring in $3.5 billion for 2022, the company is still trading like around 4 times yearly revenue here, with a market cap of $12.5 billion, and again a PE of north of 26.5. So I'm sure they could definitely pull back a little bit here. I'm looking for at least a 20-25% drop. This company should be, in my opinion, 375, not 475. So if you were thinking about taking a position in Deckers, or if you have a position and were considering adding to the position, in my eyes, I would be patient and I would just wait for this sucker to pull back down to earth and just become a little bit more attractive here in the numbers. Basically what we said about Nvidia when I did the video on Nvidia, right? Good business, revenues kept growing, everything was great. However, they took it too high. The PE was like 60, and the stock was trading like 10 times its revenue or something like that. I don't remember, but at the time, I basically told you guys, hey, they just need to sell this off, pull this back down to earth a little bit, make these metrics look a little more attractive, and then people are going to say, oh, hey, look at Nvidia. It looks good. It doesn't look overinflated. I'll step back in. I'll buy some shares of Nvidia. That's exactly what happened. They pulled the stock back a nice chunk, and then, of course, new money came in, right, because it looked attractive, and they began to slowly rise it back up. And that's basically the same thing that's happening here, in my opinion, with Deckers. I really do think that's what needs to happen. If we switch over here to the financials real quick, we can see that the revenue has basically been consistently increasing for a lot of their brands here, as we see Teva or Tiva, I'm not even sure how to say it, Hoka, look at UGG, again, maintaining that, well, actually recently broke above that $1 billion mark. But even this Hoka brand, look at this, sub 200, jumped about 50% in revenue to 277, jumped another 50% in revenue to 400 million, and then jumped over 50% from 400 to 628 million. So the company, again, is really doing something right here. Direct to consumer, as we see here, was 700 million for several years and has now jumped up to north of $1 billion last year. Well, I say last year, but it was, last year on record, 2021, direct to consumer, 1.2 billion just in that space alone. So cutting out the middleman, getting directly to the customer, that apparently is paying off very well for a company like Deckers. And if we look over here, looking at the estimates, just look at how wildly profitable they forecast this company to remain moving forward for the next 4 or 5 years. So, don't hate the player, hate the game. And at the end of the day, whether you like Deckers or you own Uggs, it really doesn't matter, because they're just consistently increasing quarter over quarter, year over year, and of course, upping their full year guidance. As we see here, was 355 billion, and the company, actually, I think estimates were originally like 3.45 to like 3.55, and the company recently came out and upped that. But we could look at the article in a second. But this is interesting too, right? Because the market cap right now is like 12.5, 13 billion. And if we fast forward all the way to 2025, and let's just say hypothetically the stock remains here at 475, now we're still looking at what, like 3.5 times total revenue, and that's at 4.8 billion if the stock doesn't move. But we're technically all the way back here at about 3 billion in change. Right? So the stock, that's why I'm saying, for multiple reasons, in my opinion, the company is due for a little bit of a pullback. However, the numbers don't lie, and you can't knock it. The company coming in above estimates on the EPS side every year, going all the way back to 2015. Same thing on the revenue side. Just coming in above estimates, consistently getting upgraded. Analysts come out, consistently increase their price targets, and that, over the years, is what steadily increases the value of an investment. That's why I tell you guys to follow the money, follow the revenue. Don't worry about what they're saying on a Reddit post. Don't worry about the email you got from some BS newsletter talking about the top 5 most short interest stocks or whatever it is. Forget all that. If you're looking to invest, not roll the dice with some random trade, if you're looking to invest, you have to look at the numbers. You have to follow the money. Because again, a company like Deckers Outdoor, probably flying underneath the radar for a lot of people out there. Now the stock's up to $500 a share. It's been basically a clear-cut winner, for the last 25, 30 years. And the company just consistently keeps growing, even during a rough economy, right? Even during 08, 09, and then we had 2012, and, then we had a 2020 pandemic, and it's like, every time the company will take a hit and move down with the market, but then immediately rebound back up to where it was, if not higher. So again, you can't really knock the company, but the PE here, 26.5. See, the last time it got up into the 20s, it immediately pulled back, and over here as well, 25, and it pulled back. But again, it seems like the median average here would be high teens, maybe even low 20s. But again, even if you think the PE 20, 21, 22 still is higher than what we feel it should be on average and should be pulling back. Again, stocks at 475 a share, in my opinion, 375. Price to sales sitting here at 3.65, the most it's been since going back to 2020, and before that, on average, about half of that. So the company trading at a pretty high multiple to sales right now, over 30 times cash flow. Only the year prior was it even remotely near that number. And all the years before that, single digits, low to mid double digits. And they're basically double that median average. So again, a lot of these ratios, a lot of these multiples are really getting out of whack here, in my opinion. Trading 7.3 times book value, the most it's been since going back to 2020, and before that, we're looking at anywhere from 2 to 4, really, 2 to 4 times book value. Right now, 7.3 times book. And if this is, where is it? Yeah, it's here on the statements. Look at that, book value, oh no, quarterly. Look at that, annually. Book value per share, according to the prior year, $57 a share. Stock is $475 a share. I mean, again, sometimes you just have to be realistic and you just have to bring the stock back down to earth to make it look more attractive than it currently is. The return on assets just maintaining that high teens level as we see over the last like 5 years in a row. Same thing on the return on equity, maintaining that high 20, low 30% mark. And the return on invested capital, same thing, 25 plus percent here, sitting here at 27% currently. All of these metrics really look pretty solid. The gross margin slowly rising over the years, broke above 50. The year prior dipped below 50, now pulled back above 50 here at 52%. So again, a lot of these numbers are really lining up well. I just think the company just went a little too high too fast and needs to pull back. Operating margin was in these low teens, jumped up to 20, pulled back to the high teens, now spiked up to 27 plus percent. And our EBITDA, once again, earnings before interest, taxes, depreciation, amortization. As we see here, the EBITDA over the last, going back, what is this, 2015 to about 2019, we can see low teens jumped up into the high teens, and then it broke above 20, pulled back sub 20, just like all of these other metrics, and then had an explosion here, sitting here north of 28%. We looked at the net profit margins before. Again, they were, about 5-6%, jumped up into the double digits. We're maintaining like that 13-15% mark, dropped to 14, now sitting here north of 20%. So again, a lot of these numbers are lining up well. I just think it should go down before it goes back up again. And the inventory turnover caught my eye because as we see here, it was bouncing around here, low threes up to about mid threes, broke up into 4. Now it's sub 3, sitting here at 288. And the asset turnover as well was maintaining about 1.5 for a while, dropped down to 1.25. Now it's only sitting here at about 1.33. So this has been rocky over the last couple of years. So I don't necessarily, I'm not going to go on record and say this right here, this number going down is why the stock should drop 40%. Definitely not going to become a realistic scenario, in my opinion. However, could add to the situation, right? Little high PE, little overinflated market cap, inventory turnover dipped a little bit. That's what I mean. High ratio to cash flow, high ratio to book, right? The enterprise value, which again is what another company would pay to buy the company out. The enterprise value, which is supposed to be a premium to where the stock is currently trading. The enterprise value is currently lower than the current market capitalization of Decker Outdoor, which means if this company received this $12 billion bid right now this second, the stock would drop 7-8%, or whatever that difference is, from 12.6 billion to 12 million flat. So, we looked at all this basically. And yes, also here, again, going back to the estimates, you can see this company just consistently coming in above estimates on the revenue side, and of course on the profitability side, almost doubling the EPS from 2019 to 2021. Cash flow remains positive. The debt here jumped up from 30 million to about 300 million as we see, but has slowly pulled back here over the last couple of years down to about 220 million. Nothing really to raise a red flag about. And when it comes to assets and liabilities, as we see here in 175 short-term assets, about half a billion in liabilities, 600 plus million on the long-term assets, 300 million in liabilities. So the company's sitting here with about 2.4 billion in assets and about 800 million in liabilities. So that's roughly a 3-to-1 asset to liability ratio. So that's why I'm saying a lot of these fundamentals really look phenomenal. And if you tell me, you bought this years ago or you like the stock, no one's going to call you crazy, right? Because the numbers aren't lying. But again, couple of metrics out there looking a little high to me in my opinion. So I do think we're due for maybe a 20 to 25% pullback. You might see a clean $100-$120 pullback here off this level down to about the mid 300s. And going back here in the short term, looking at the technicals again, we had our rising wedge over the last month or so. It recently broke, has a big pullback here today of almost 3%. Looks like markets are going to continuously sell off in the next hour, roughly going into the close. So this company may begin its downtrend here. And of course, backing up, looking at this max chart, we can see, well, this is a max chart, but we can see again that rising wedge that it just broke right here is inside of this other rising wedge, which may potentially break in the next few months, which is inside of this longer rising wedge, which is bringing us to an apex in middle end of 2026. And this apex, if it does take this long, is 2029. So that's why this is really an interesting scenario, because on one hand, it should continue to rise and stay in this predetermined channel. However, on the other hand, it is overinflated and it really needs to have a massive sell-off back to these lower trend lines to keep it attractive, to bring the metrics back down to earth so that new money comes in and pumps it and bounces it off of the bottom trend line and keeps it in this range. Now, again, going to this apex here, we're looking at, $1,200, $1,300, $1,400, $1,500 a share. So honestly, I'm not really sure if it will ever get to that point. However, in my opinion, if I was running Deckers here, what we see here is the massive decrease in volume over the years, and that's because the stock was at 40, went up to 100 and change, bounced around, and then went from sub 100 to almost $500 a share. So of course, the volume slowly decreasing. So I don't know. If I was behind the wheel, I might call for a 3 or 4 for 1 stock split potentially. But that's just me. But moving in here, as we see, if it breaks this, it will most likely pull back to this fib here, about 430 here in the short term. And if it does really get slammed back to this bottom trend line here, again, this is going back to the bottom and the highs during and after COVID. And as we see here, you're looking at a pullback here at 360s, potentially 370, 372. So that, in my opinion, is where the stock should be. Earnings coming out May 25th. That will, again, be huge, because then if the fundamentals don't line up while we're inside of the technical, inside of a technical, inside of a technical, inside of a technical, then what's going to happen is they will really begin to break the stock down. So you got to keep an eye on these earnings, as I always say. They are really the bloodline, the lifeline of the value of a stock. And again, back over here at stock charts, we can see the MACD has turned, obviously was absolutely raging over the last couple of months, so definitely due for a pullback. Company was riding this top Bollinger Band. RSI was up to about 78. Now on the daily, it pulled back to about 64, but 437, as we looked before, is not only just about around the fib level, but it's also this 50-day moving average on the daily, and we see multiple tests over the last 6 months coming back to the 50-day. So that will most likely be the next stop. And even this 200-day of 375, again, I think that's justified, because the RSI will begin to pull back. The MACD will cross downward as the stock sells off and comes back down to earth, which will add to the pullback. So again, that's why I'm saying sub 400 in my eyes. I think it's very, very feasible here. Bouncing off the mid-Bollinger Band several times here, that's pulling back to 423. But again, the bottom Bollinger Band here, 365.97, and our 50-day of 360. That, in my opinion, is where the stock should be. Stock should be between like 360 and 370 right now. This 200-day moving average, 286. Again, if these earnings come in really light and it's their first like crappy quarter in a while, and we're potentially breaking out of these rising wedges, I mean, you could see a massive pullback, 35, 40%, whatever this is, back to 286. But I just don't know if that's really going to happen anytime soon. But you never know what a company could say or what news can come out about a stock. Again, even on the weekly, the RSI was up at like 75, so now it pulled back. It's still above 69 a little bit, so the company on paper definitely viewed as overbought and will most likely begin its sell-off. And again, you can see, look at this MACD just absolutely raging, going back roughly about 12 months from today. So that's what I mean. The company just straight beelined since basically the middle of 22 up to where we are now, closing out the first half of 23. So again, did it deserve a rally? Yes. Should the rally have stopped a little while ago and they began to sell off the stock? Yes, in my opinion, yes. So that's why I'm saying Decker's Outdoor seems to be a good company. The numbers are lining up. We have a lot of good fundamentals, a lot of good business revenue coming in for the stock. But at the end of the day, we do have some technicals lining up, And again, we have a pretty high PE, pretty high revenue to market cap multiple. So that's why I'm saying I think this company may be due for a pullback, and I think it really may accelerate right here at the end of May, pending that earnings report. But I'm going to leave it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. Just like everyone on YouTube says, like the video, thumbs up, algorithm. That's what it's all about. Subscribe to the channel if you have not, right? That's our simple handshake. I'll make the videos as often as I can. I'll review whatever symbols you guys throw my way. We can look at them together. And, all I ask is that you push the subscribe button. Love to see the community slowly grow over time. And again, shout out to Frank, who let me know in the comments section that the audio for this previous video was messed up, so I had to delete it and re-record it today. Thank you, Frank. I appreciate you, sir. And more importantly, moving forward, like I always say, I understand markets are rocky, and they're volatile, and they're uncertain. So I want to wish everyone success. Hope everyone makes a couple of dollars. I want to thank you for stopping by, and I'll see you in the next video. Peace.